Right, this video is going to take a look at a very popular ratio, one that's not always published. Companies don't have any obligation to show this information, but one that analysts and many investors like to use. It's rather a mouthful. It's called EV to EBITDA. It's a ratio, so it's a bit like a price to earnings ratio, for example, and its purpose is to work out whether a share is cheap or expensive using the most reliable, accurate and comprehensive ratio possible. So, what is EV/EBITDA? Well, the EV is enterprise value. Enterprise value is the total market capitalization of a firm's equity provided by shareholders and net debt. That's long and short-term debt minus cash. And that gives a comprehensive valuation of the firm using both of its major sources of funding, shareholders and, let's say, banks or lenders. EBITDA is a profit figure. It's short for earnings before, and then the ITDA, interest on bank loans, for example, tax, that's corporation tax, depreciation, and amortization. So it's quite a mouthful. Now, we'll take a look at this in a bit more detail in a moment, but that's just what these are for. So it's enterprise value to a profit figure of some sort, and that's going to be expressed as a multiple of that to give a ratio, a number, and this is earnings before interest, tax, depreciation and amortization. So, what's the point of it? Why would we want to actually do this ratio at all? Because if we're trying to work out if a share is cheap or expensive, don't we just use a PE ratio, for example? Isn't that a fairly popular way to do it? Well, it is one way. So, for example, looking at, say, Tesco's accounts for February 2010, fans of a PE ratio would say, actually, Tim, all I need to do to work out whether Tesco is cheap or expensive is simply compare its current market price. The P is Tesco's market capitalization or market cap, and the E is simply profits after tax. Now, we've looked at PE ratios in more detail elsewhere, but a price to earnings ratio is just the contribution of shareholders as a multiple of 1 year's profit after tax. And for Tesco, you could crunch that for February 2010, picking up the numbers which are now widely available on Bloomberg or Digital Look, and you get a market cap of about 33,537 and 1 year's profits after tax, taking you up to February 2010, of 2327. Those are in millions, and that generates a price to earnings ratio of around 14, more or less 14. Okay, now fans of the PE ratio would say that's fine. What that tells me is that if I buy Tesco at today's share price, it's going to take me about 14 years at that rate to get my money back, let alone make anything. So let's have a think about how that compares to other food retailers and the wider FTSE 100. But that's all fine. Price to earnings ratios and the theory behind it are fine. But fans of this ratio say there are two problems. Not so much with how you interpret that, actually two problems with the components of the PE ratio. Number one, the P isn't comprehensive enough. That is the contribution of equity shareholders to Tesco. What about banks? What about lenders? Where's their contribution shown? If this is meant to be the total value of Tesco in some way, as a way of working out whether it's cheap or expensive, isn't there something missing? And down here, the E, profits after tax. Is that really a representative earnings figure for a company such as Tesco? Because isn't it stated after lots of costs which have got nothing to do really with operating a supermarket business directly, and also are a little bit subjective? What I mean by that is some people would say, you know, tax is subject to tax rules. It's got not a lot to do with the inherent profitability of the Tesco business. Interest reflects decisions about how the firm has been financed rather than how it's run. And depreciation and amortization are these weird adjustments that finance directors make to arrive at this number by saying, well, our assets will last roughly 10 years, for example. Who says? They do. So we'll take the cost of all our assets and spread it over 10 years worth of profit and loss accounts. Now, without even understanding exactly what's going on there, if it sounds a bit dodgy, that's because it is. So fans of this ratio would say, what you want to do, Tim, is this. You want to replace market capitalisation with something more comprehensive, enterprise value. And you want to replace this with something which is closer to a more reliable figure for earnings. So we don't want profit after tax. We want something like this, earnings before too much nonsense has been stripped out. So before interest, tax, depreciation and amortization. And fans of EBITDA would say, right, start again. Yeah, if you're going to calculate it, let's do it by replacing the P with an EV and profits after tax with an EBITDA. Now the problem is you may have to do a little bit of work, or somebody would do it for you on a website to get to these numbers. They don't just always jump out at you off, say, the firm's balance sheet or profit and loss account. But that's not a problem, and normally the figures are done for you, but it's worth knowing roughly what's going on here. So market capitalisation, that's fine, we can leave that. Enterprise value, as we cover elsewhere, is that plus any net debt, which is long and short-term borrowings minus cash on the balance sheet. So what is that at the same date, February 2010, for this purpose? Well, we could look that up and we'd find it's around 9140 in millions. So the total enterprise value, we're still working on this half at the moment, is those two combined, or about 42,677 million. So Tesco's enterprise value is around 42,677. What's this, EBITDA? EBITDA, what you could do is take the profit after tax figure and work back up the profit and loss account. So in other words, add back interest, add back tax, add back depreciation, add back amortization. But fortunately, most analysts that quote this figure have done the job for you. But that's the principle. We're taking the profit after tax figure and stripping out these four items. And in Tesco's accounts, that would leave you with an EBITDA number of around 4464. Again in millions. So enterprise value is 42,677, EBITDA 44,644. So the ratio between that and that is simply that over that, and that's around 9.5 times. So Tesco's had a PE ratio of around 14. By revising that and turning it into EV/EBITDA, that drops to 9.5 times. And the point is this, you then carry on your inquiries as you would with a PE ratio. So you'd say, well, is that cheap? Is that expensive? The lower that is, the cheaper the share. But to get a real feel for whether that's low, you'd want to compare Tesco to other food retailers and possibly the wider market in terms of the FTSE 100. But the point is that many analysts see EV/EBITDA as a more reliable way to compare companies in a particular sector, a more comprehensive way, you might say, than the simple PE ratio.